Turn to Professor Mario Seccareccia from the University of Ottawa. Mario, please.
Thank you, Paul, for that. And I would also like to thank the organizers and Rob Johnson in particular to give me the privilege here to actually be able to present some of this stuff. Now, what I'm going to talk about, in fact, is one is the way we've actually gone about in addressing the crisis during the last few years, but also look at it in some perspective initially and see how, in fact, we could consider an alternative way of doing this if we go back to history a little bit here, and especially going back to Keynes, which has been my inspiration, as we'll see here, and the way in which he conceived of the whole problem of stabilization, which he considered to be a kind of long-term issue. How do we deal in the long run in stabilizing the economy, not necessarily by fine-tuning on the short-term basis, which is the way, to some extent, it has been accepted now. But let me just quickly say something just prior to the financial crisis, what happened there. If you look at all governments, and this is the case for all the major, the G7 countries, you could see that just prior to the financial crisis, everybody was trying to, in fact, almost tripping over each other, trying to get surpluses. Not, in fact, many of them did, in fact, but Canada and Germany did succeed. Okay. Others were trying to get close, even the US in this case. So everybody was trying to do the same thing. And then obviously what happened after the financial crisis, everything kind of, they all went into the red, of course. Now, if one looks at the experience of both the Great Depression of the 1930s and also what happened during this time around, you will notice here that, in fact, in all these two cases here, the policymakers took a kind of two-pronged approach to the issue. One is that they went the route on the monetary policy front first, which was to try to get interest rates really down to the practically zero level, as Richard has mentioned in the case of Japan as well, and so as to maximize, as I say, the monetary stimulus. At the same time, of course, they also attempted to run deficits, discretionary spending in this case, and especially in the areas of public investment, which politically seems to be the most agreed upon form historically, and in both cases here was preferred. Now, indeed, also what we find is that once the policy authorities see that there's a kind of turnaround in the economy, they quickly put on the brakes, basically. And you're starting to see this now, as we saw this in 1936-37 with the recession there, and perhaps triggering a kind of a double dip here. So, I mean, this is the reality. Now, if you look at the way in which the mainstream, in a sense, of our profession has looked at this, okay, the new consensus that, in a sense, came to reject the old-lying sort of monetarist explanations, if you go back to the 1970s and even early 80s, emerged, which basically articulated a view that we should, in the short term, indeed, if we have, for instance, a situation where we are hitting where monetary policy is no longer feasible. Now, obviously, the preferred mode for the new consensus in our profession was monetary policy. It was deemed all-powerful. But in times of crisis, it was recognized, of course, especially as a result, not just of what happened now, but even in the case of Japan again, that there was a recognition that there is, of course, a lower bound, and hence the need for fiscal stimulus as something as basically a temporary measure. Otherwise, in the normal functioning of the economy, we should not be running deficits, because eventually deficits do bring up the inflation rate, and hence eventually also get the central bank to react by raising interest rates and thereby, in this case, crowding out investments or private sector spending, et cetera, et cetera. Now, this has been the way in which it has been conceived in as I said, within the mainstream. But I think there's an alternative perspective to which, to some extent, even Richard here has pointed to, which is a sort of modern financial flow view here, which is or what I refer to as modern monetary theory in a sense. As I say there, basically, we have to conceive in a modern economy that if we want to have growth in the system, as people like Schumpeter and Keynes to some extent did emphasize, if we want to have growth in the system, somebody has to hold that hot potato of debt. So it's either going to be the private sector or the public sector. Simple as that. And the question, therefore, being, who is going to hold that hot potato in order to sustain growth over time? Now, what is important, however, is that whoever does go into debt, whoever runs the deficit, there's a counterpart to that. It's not some sort of black hole that, let's say in the case of the government sector, if it runs a deficit, okay, that somehow this has all these negative consequences here. What it allows is the fact that the private sector to deleverage and to be able to raise its savings rate, its desired savings, to meet, in fact, their needs. So if you look at it in terms of just a standard way of conceiving here, as I show here, going back to writers, I mean, many writers, I refer to Godley there, but indeed, many, if you just consider the standard, financial flow, how you could, in fact, show in this case, for instance, as I showed there, that if you look at the gap between PX is private sector expenditures, Y minus T there is disposable income of the private sector, is by definition equal to the public sector deficit or surplus or balance, as well as the current account balance, if you wish. I mean, that's by definition. So for a given current account balance, you're going to have more or less a mirroring of, whatever happens in the public sector must be mirrored in the other sense by the private sector in some way. And I just showed some statistics here for Canada that I have available, which you could see pretty much mirrors it. Now, the only reason why it doesn't mirror it exactly, of course, is because of the current account balance, as it could vary and it could perturb that a little bit. But otherwise, what we have here is, the blue line here, which is, of course, the total private sector lending borrowing, and the red, which would be the government sectors, consolidated government sector net lending and borrowing. And you could see right away, during the time when we had our so-called big deficits of the 70s and 80s in Canada, the private sector, of course, found itself in a very comfortable position with regards to savings here. Well, when the government sector, of course, began to run surpluses starting in the mid to late 1990s, and we did so. In fact, it's always been referred to that Canada, in this case, has been celebrated as being one of the few countries that actually was able to sustain and indeed maintain over a whole string of deficits for a dozen years, for instance, in this case, as we could see from that chart there, from the mid to late 1990s all the way to the crisis, basically, we were targeting surpluses. And of course, what you see is that the private sector, to some extent, was finding itself in a more difficult position here. But in fact, what's more important was when you disaggregate it, what one finds there is that, in fact, it was mostly the households that found themselves in a rather difficult position. As you could see, for instance, if the blue line there, which is the household sector, you could see how, in fact, they were the ones who, throughout that period, suffered the most, so to speak, here, that were that were put in the red as the public sector deficits, surpluses were achieved during that period, rather. Now, so what I'm trying to get up to here is that, I mean, there is a need for functional finance here that tries to deal with the fact that, obviously those statistics there, of course, are just simply accounting identities and do not tell us the causality exactly here. But, clearly it's a two-way causality, but the point of all that is that if the private sector does not and cannot, in fact, and does not borrow sufficiently to sustain growth, it has to be done through the public sector. And that's the basic logic of the functional finance here. And in fact, especially in the current context where many automatic stabilizers have been slowly eroded here for obvious reasons, as governments have been seeking to target surpluses until the financial crisis, what we found is that these automatic stabilizers were slowly disappearing in Canada in particular. And therefore, even more the need for discretionary kind of functional financing. Now, what I do wish to argue, though, is that what is needed is also some commitment in the longer term to be able to sustain demand so that it's not susceptible to the whims of the private sector alone in order to be able to achieve sustained growth over the long term. And for this reason, what I've argued here is that what is needed is something more akin to what Keynes had argued in the 1930s and 1940s in favor of what he called the socialization of investment. And there what I argue basically is that in fact, I even quote Keynes here, and I won't try to burn you with that. Anybody could probably access my paper easily on the net. But the point of this is that Keynes did argue in favor of a strong commitment on the part of the state to be able to sustain over time a certain growth of the economy, sustained not by private investment, but by public investment. In fact, at one point, he refers to that as much as 2/3 to 3/4 of total investment ought to be under some sort of influence by these public, or semi-public bodies, as he refers to there. And indeed, not to be, in fact, susceptible to the whims of the private sector alone. And so in the form of public infrastructure, et cetera. Now, there are two readings in terms of how he actually conceived of this. One of them is in terms of a national investment board he talks about, which was in fact even in the political platform of the Labour Party during the early 1930s rather. And however, he did not subscribe to this particular form that had been put forth at that time. That contained the nationalization of the banks and all sorts of other stuff. But he did argue in favor of a national investment board that would be almost like a kind of infrastructure, national infrastructure bank, okay? Investment bank, and that would be able to let's say, sustain over the long term a certain level of public investments that are needed. Now, this is one reading of it, but there are other readings as well, which has to do with the way he conceived of capital budgeting on the part of the state. And here he argued, of course, that what needs to be done here is to try to yes, you could try to, in fact, he even pointed out that, indeed, if there is a deficit if you separate, excuse me, just go back here, if you separate the account of the state into the capital account and its current account, or ordinary account, as he called it, well, if you have a deficit in your ordinary account, this is really a sign of a problem having to do with the fact that you have not enough sustained public investments in the economy. So what is needed is to have, in fact, a continual deficit in your capital account, if you want to call it that, in order to be able to generate surpluses in your current account. Okay? Now, he goes through the whole logic of this, and I will not have time to elaborate in any detail, and I do refer to it in the paper, but the point of this is that he attempted to both show the need for some body that would actually go about and sustain this public investment over time so as to make it a kind of what he calls a make weight in the system, okay? Or a kind of center of gravitation almost for the private sector investment that would be sustained on the basis of what is going on underlying the inertia coming from the public sector's investment. And he made it quite clear. Now, if you actually, I'll skip a lot of this stuff here, but I'll just give you an example in the case of Canada here that I had data for easily. And if you look at the actual the evolution of public investment as a share both of private investment here, you could see that how it declined dramatically since the 1960s. I had it from 1961 here, the data. And it only jumped up during this crisis, but primarily because the denominator here, okay, fell so dramatically. It's the private sector investment here. Okay? Now, if you look at it as a percentage of government outlays in the economy, of government expenditures in the economy, you could see that it just went up a little bit during the crisis, which indicates, in fact, this net preference here for public investment, but how dramatically it had fallen, from over 50% of government expenditures all the way down to around 10% approximately throughout that era of the 80s and 90s, as we could see there. And I do indicate now, in this case here, how we could attempt to redress this by essentially return to a higher rate of public investment in the economy that would do exactly what Keynes was trying to do in terms of sustaining growth and without any serious fluctuations, regardless of how the private sector, in a sense, would behave in regards to matters of the economy. And I will not go through that here, other than to say that I do indicate how we could be able to go back and achieve a rather, more sustained growth by means of public sector investment. Thank you.
Okay, thank you very much, Mario. Thank you indeed.